What if everything you thought you knew about money is already outdated? In 2008, the world watched as financial markets collapsed, but beneath the panic, a silent revolution began. Today, money isn't just disappearing from wallets, it's being transformed into lines of code, buried in decentralized networks, and controlled by algorithms rather than bankers. We're no longer just spending cash, we're interacting with a living, evolving financial organism. And whether we realize it or not, that shift is redefining the way societies, governments, and individuals relate to wealth. As Nobel Prize-winning economist Milton Friedman once said, "Only a crisis, actual or perceived, produces real change." That moment came in the wake of the 2008 global financial crisis, not just shaking the system but rewriting its very foundation. Since then, a trio of seismic forces has accelerated this transformation: financial technology innovation, shifting monetary policies, and global behavioral change. These aren't mere trends, they're structural revolutions reshaping the soul of the financial system. To make sense of this shift, think of money like water. It used to flow through defined channels: banks, cash registers, ATMs. Now, it's like a digital stream, frictionless, borderless, and often invisible. Mobile wallets turn phones into banks. Cryptocurrency sidesteps governments entirely. AI-powered platforms offer loans without human bankers. But with such fluidity, who holds the dam's keys? And more importantly, who benefits when the rules change overnight? In an age where money can be mined, coded, or even gamified, the question isn't just what is money? It's who gets to define it? Is it central banks with printed currency, or decentralized communities running blockchain networks? When algorithms decide creditworthiness and policies fluctuate with political cycles, how can the average person stay financially literate, let alone empowered? These are no longer theoretical concerns, they are practical questions shaping your everyday choices. The future of money isn't coming, it's already here. To thrive in this new financial era, we must question old assumptions, understand emerging systems, and stay engaged with the technologies reshaping value itself. Because the most dangerous position in a shifting system is standing still. The real measure of your wealth, said philosopher Ralph Waldo Emerson, is how much you'd be worth if you lost all your money. Let's build that kind of financial awareness together. About the author. Richard Holden is a distinguished economist and professor at the University of New South Wales. Currently serving as president of the Academy of the Social Sciences in Australia, he brings deep expertise to the study of markets and institutions. A Harvard PhD graduate, Holden has also held teaching positions at prestigious institutions like the University of Chicago and MIT. His body of work includes the acclaimed Australia's Pandemic Exceptionalism and the widely used textbook Principles of Economics, which he co-authored. Key Takeaway 1. How 2008 quietly rewired global money, the rise of digital, mobile, and decentralized finance. In 2008, while headlines focused on crashing banks and vanishing wealth, a quieter revolution began, one that would radically reshape our relationship with money. That year, interest rates in major economies plummeted, smartphones began infiltrating daily life, and an obscure digital experiment called Bitcoin quietly went live. These three developments, largely overlooked at the time, would go on to redefine how money is created, moved, and controlled, not by governments alone, but by code, apps, and global networks. As famed economist John Maynard Keynes once said, "The ideas of economists are more powerful than is commonly understood." In the wake of the financial crisis, central banks slashed interest rates to historic lows. But even after recovery, those rates remained stuck near zero, a sign of deeper economic shifts. The natural interest rate had collapsed. Why? Because today's tech giants scale with code, not capital, retirees save more, and inequality concentrates wealth in fewer hands. The result: too much money, too few good investments. The age of cheap money had quietly arrived. At the same time, your phone became your wallet. From mobile money in Kenya's open-air markets to contactless payments in Scandinavian cafes, the smartphone revolution turned financial services into software. No need for bricks-and-mortar banks. Apps like PayPal, M-Pesa, and Venmo made digital payments frictionless, intuitive, and borderless. Can you imagine trying to function today without the ability to pay with your phone? But the most radical change came with Bitcoin, a digital currency designed to exist without a central authority. Powered by blockchain, it offered a new blueprint for money itself: programmable, transparent, and decentralized. What began as a rebellious tool for crypto anarchists now commands attention from billionaires, banks, and governments alike. If money can be created without borders, who really controls it? And what does that mean for the future of sovereignty? Together, these three forces, ultra-low interest rates, mobile finance, and decentralized digital money, form the pillars of a new monetary era. In the next section, we'll explore what this means for everyday life as cash slowly fades into the background. But for now, ask yourself, if money no longer needs banks, borders, or even paper, what kind of financial world are we building? Stay curious, stay informed, and if you're ready to challenge the status quo, keep listening. Key takeaway 2. The death of cash, why your wallet may soon be obsolete. In 2010, nearly 4 out of 10 Swedes paid with cash for everyday purchases. By 2020, that number had plummeted to just 9%. This isn't just a shift in habits, it's a financial revolution. Across countries like Sweden, Australia, and even parts of Africa, cash is being dethroned by seamless digital payment systems that offer speed, security, and traceability. Quietly but irreversibly, we're witnessing the end of cash as the default medium of exchange. Technology is leading the charge. With tap-to-pay cards, mobile wallets, and smartwatches, paying for coffee or groceries now takes seconds. Digital infrastructure, like real-time payments systems, has turned smartphones into portable bank branches. As economist 𝐬𝐿𝐴 explains, the world is moving toward a cashless society not because of a grand plan, but because of digital convenience. When was the last time you truly needed an ATM? Yet not everyone can, or wants to, join the digital wave. Elderly citizens, low-income earners, and the unbanked still rely on cash for survival and autonomy. As former Reserve Bank of India Governor Raghuram Rajan warned during India's abrupt demonetization in 2016, removing cash too quickly can disrupt lives and widen inequality. The poorest often lack access to digital tools or the literacy to use them, making sudden shifts not just inconvenient, but devastating. That's why smart transitions matter. In highly digitized nations like Australia, a gradual, phased approach to phasing out physical cash, spread over a few years, can work. But even in tech-savvy regions, people value cash for privacy, control, and personal comfort. Still, as digital payment adoption accelerates and systems become more integrated, the rationale for keeping cash diminishes. Convenience and efficiency are winning the day. So, what replaces cash, and who will control it, is the defining financial question of our time. Will it be central banks issuing digital currencies? Private fintech firms? Or decentralized blockchain-based solutions? The story of money is being rewritten right now. If you want to understand the next chapter in finance, stay tuned. Key takeaway 3. How mobile money is ending poverty, one phone at a time. Imagine transforming lives not with banks or branches, but with a simple mobile phone. That's exactly what's happening across rural Kenya and Afghanistan, where mobile money has quietly achieved what traditional banking systems couldn't, providing safe, fast, and inclusive access to finance. In areas with limited infrastructure, this digital financial revolution isn't just convenience, it's survival. In fact, mobile payments are redefining what it means to participate in the modern global economy. At the heart of this transformation is the marriage of mobile technology and digital finance. In wealthier nations, tap-to-pay and Apple Pay are seen as luxury. But in the global south, mobile money is a lifeline. Randomized studies in Kenya show it has reduced extreme poverty, especially among women. In Afghanistan, paying police officers via mobile reduced bribes and improved morale. As economist Abhijit Banerjee once noted, small innovations can make a huge difference when they scale in the right hands. This shift also challenges our traditional understanding of money. For centuries, central banks controlled currency, governments taxed it, and commercial banks managed deposits. But today, apps and platforms are becoming the new financial gatekeepers, moving money, storing value, and recording transactions at the tap of a screen. While inflation and interest rates still matter, they're now shaping behavior in a digital context, not through teller lines or checkbooks. Even in advanced economies, this shift is profound. Phones have become personal banks, enabling real-time payments and contactless transactions. But the real story unfolds in places long excluded from financial systems. When access to finance fits in your pocket, economic empowerment spreads. It sparks entrepreneurship, improves household resilience, and reshapes national development strategies. Fintech is no longer just about innovation, it's a tool for equity. So here's the big question: what happens when mobile finance challenges traditional currencies themselves? As we move deeper into an era of digital wallets, private currencies, and decentralized platforms, one thing is certain: money, as we knew it, is evolving fast. Key takeaway 4. Crypto versus governments: who controls the future of money? In a quiet New Hampshire town, you can buy frozen yogurt with Bitcoin and overhear neighbors passionately debating the merits of Ethereum over dinner. It might sound quirky, but it reveals a profound truth: cryptocurrencies are no longer fringe experiments. What began as an underground movement is now a multi-trillion-dollar global phenomenon, and it's rewriting the rules of how we create, use, and control money. The spark? A 2008 white paper by the mysterious Satoshi Nakamoto, outlining a bold idea: money without banks or governments. That idea became Bitcoin, the first decentralized digital currency, and it lit the fuse for a financial revolution. At the core of this shift lies blockchain technology, a decentralized digital ledger that verifies transactions through code and community consensus, not central banks or legal courts. As Nobel laureate Paul Romer once said, "A crisis is a terrible thing to waste," and post-2008, people were ready for a new monetary vision. Think of blockchain as trust without intermediaries. It enables strangers to transact securely, transparently, and instantly, without relying on traditional authorities. Ethereum, founded by the visionary Vitalik Buterin, took this concept further by embedding smart contracts, agreements executed automatically by code. This breakthrough transformed the financial landscape, spawning a world of decentralized finance, DeFi, NFTs, and new economic models, all orbiting around programmable, trustless value. But with innovation comes complexity. These digital currencies gain strength through network effects. The more users they attract, the more entrenched they become. That raises new questions. Are we simply trading old monopolies for new, private ones? What happens when your bank isn't a bank, but an algorithm? As adoption accelerates, governments are scrambling to catch up, some choosing to regulate, others preparing their own central bank digital currencies, CBDCs, to compete in this new era. So here's the crossroads: do we follow decentralized dreams or reinforce state control? The battle for the future of money is just beginning, and you're a part of it whether you realize it or not. If this excites your curiosity, don't go anywhere. Key takeaway 5. GovCoins versus crypto: the global battle over digital money has begun. When Facebook announced its own global digital currency in 2019, originally called Libra, later renamed Diem, governments didn't just raise eyebrows, they raised red flags. Imagine a private tech company with over 2 billion users issuing its own money. That's the kind of power that made policymakers like U.S. Treasury Secretary Janet Yellen push back hard. Though the project stalled under pressure, the message was clear: tech giants weren't just disrupting communication, they were eyeing monetary sovereignty. Enter the central bank digital currency, CBDC, government's direct response to the rise of crypto and corporate-backed coins. Unlike volatile cryptocurrencies, CBDCs are digital forms of national currencies, issued by central banks and backed by state authority. They offer the security and legitimacy of traditional money, while embracing the speed and convenience of modern digital finance. In an era where cash is fading and mobile wallets are the norm, this is government's attempt to stay relevant in the money game. But building a GovCoin is a delicate balancing act. It must be user-friendly, fast, and secure, yet also respect privacy, uphold regulations, and coexist with current financial systems. Take the U.S. proposal for a FedCoin, a government-backed digital dollar that wouldn't require energy-guzzling blockchain mining. Instead, it would use a centralized ledger controlled by the Federal Reserve, enabling efficient digital payments, tax enforcement, and possibly even smart contracts. It's like bringing the US dollar into the age of code. Still, this innovation brings disruption. As physical cash fades, concerns emerge: who has access? Who controls the data? How much oversight is too much? While the US weighs its options, China has already piloted its digital yuan, signaling that the race is on. These GovCoins could reshape the balance of financial power, not just between people and banks, but between nations. So here we are: public money versus private innovation, democracy versus digital centralization. This isn't just about tech or finance, it's about the future of economic freedom. Stay informed. Stay empowered. Key takeaway 6. Will digital currencies end the US dollar's global dominance? In the world of money, the US dollar has reigned supreme for decades. It's the currency nations trust, central banks hoard, and international trade depends on. This exorbitant privilege has given the US unparalleled economic leverage. But what happens when that privilege is no longer guaranteed? As digital currencies rise, the dollar's dominance faces its most serious challenge in generations. One major challenger is China's digital yuan, already rolled out to hundreds of millions. It's not just a new payment tool, it's a geopolitical strategy in disguise. Unlike legacy systems like SWIFT, which flow through US-controlled pipes, China's digital currency could bypass Western oversight altogether. Sanctions? Less effective. Dollar dependence? Rapidly shrinking. As historian Neil Ferguson once said, the empire of the future will be monetary. China seems to be building it one line of code at a time. Meanwhile, the US has hesitated. The Federal Reserve is studying a digital dollar, but political gridlock and institutional caution have slowed progress. In global finance, timing is everything. Once a digital standard takes hold, be it public like China's or private like Apple's, displacing it becomes nearly impossible. The US may find itself reacting, not leading, in a race it once dominated. And there's another wild card, big tech. If Amazon, Google, or another tech titan creates a digital currency with widespread adoption, they could challenge governments outright. Imagine a world where monetary policy isn't set in Washington, but shaped by corporate algorithms. What does that mean for sovereignty, accountability, or even democracy? This isn't just a tech shift, it's a monetary revolution. As digital infrastructure rewires the financial world, we must ask, who gets to write the rules? In the next chapter, we'll unpack how old economic challenges, like debt and asset bubbles, collide with this new digital reality. Key takeaway 7. Why low interest rates are rewiring the global economy. In the early 1980s, US interest rates soared above 15%, crushing inflation but nearly breaking the economy. Fast forward 4 decades, and the pendulum swung in the opposite direction. Interest rates hovered near zero for over a decade, even as governments unleashed record spending and central banks flooded markets with money. This seismic shift wasn't just a policy experiment, it signaled a deeper transformation in the way modern economies operate. So, what's really behind this age of ultra-cheap borrowing? According to leading economists, it's a mix of technological efficiency and demographic shifts. Unlike the industrial giants of old, today's titans, like Google or Meta, scale with minimal capital. Add to that the rising global pool of savings, concentrated in aging populations and wealthy elites who tend to save rather than spend, and you get a persistent excess of money chasing too few real investment opportunities. As Nobel laureate Paul Krugman puts it, sometimes the problem isn't scarcity, it's too much money with nowhere to go. But easy money creates fragile markets. When cash is cheap and abundant, it often flows into risky assets, from housing and stocks to cryptocurrencies. Remember the 2008 housing collapse? That wasn't a fluke, it was a symptom of deep imbalance. And today's financial landscape shows similar signs: inflated valuations, speculative manias, and bubbles waiting to burst. Can central banks intervene? Yes, but they're operating in an economy fundamentally altered by structural forces. Some argue this environment allows governments to spend freely and print money without consequences. But history warns otherwise. From Weimar Germany's wheelbarrows of cash to Venezuela's recent collapse, we've seen the dangers of ignoring fiscal discipline and inflation risk. Even in a digital world powered by central bank digital currencies, sound monetary policy and responsible governance remain essential. The challenge ahead is profound. How do we build a resilient financial system amid low interest rates, rising inequality, and evolving digital tools? We're not just changing how money moves, we're reshaping the rules of the economy itself. Stay with us as we explore what it takes to build an inclusive and sustainable financial future. In summary, in a world where cash once ruled the economy, the very definition of money is now being rewritten before our eyes. Richard Holden's Money in the 21st Century dives deep into this transformation, revealing how technology, policy, and shifting global dynamics are disrupting everything we thought we knew about finance. The book begins with a bold observation: money is no longer just paper or coins, it's a force embedded in our devices, dictated by algorithms, and shaped by players well beyond traditional banks and governments. Holden highlights 3 powerful shifts that ignited this change in 2008, near-zero interest rates, the mass adoption of smartphones, and the birth of Bitcoin. These developments weren't just technological marvels, they altered the core mechanics of monetary systems. As governments kept rates low for years and mobile phones replaced bank branches, a new kind of financial infrastructure quietly took shape, one that is faster, more global, and less reliant on central authority. The book also explores how digital payments have revolutionized financial inclusion, particularly in the developing world. Mobile money in rural Kenya and Afghanistan has empowered people, reduced poverty, and even curtailed corruption. By merging mobile technology with digital finance, communities once excluded from formal banking are now participating in the global economy, proof that innovation can bring dignity and opportunity. But the story doesn't stop with inclusion. Holden takes us to the front lines of the crypto revolution, where decentralized currencies like Bitcoin and Ethereum are challenging the monopoly of state-issued money. Through blockchain, these assets offer a way to record and transfer value without banks or governments. They are not just currencies, they are ideologies coded into software, prompting us to rethink trust, authority, and ownership in financial systems. The public sector hasn't stood still. In response to private digital currency threats, governments are racing to issue their own central bank digital currencies, or GovCoins. China leads the charge with its digital yuan, while the US cautiously explores a digital dollar. These official digital currencies aim to preserve monetary control, but they raise questions about privacy, regulation, and the future role of banks in a world where cash is disappearing. A key insight from Holden's work is that financial systems are being reshaped not just by technology but by deeper economic trends. Global savings surpluses, aging populations, and the rise of capital-light tech firms are driving down natural interest rates, distorting investment flows, and increasing the risk of speculative bubbles. In such a world, cheap money can be both a blessing and a trap, fueling inequality while complicating public finance. Holden doesn't shy away from tough questions. What happens when tech companies gain the power to issue money? What does financial stability look like when savings outpace investment? How do we safeguard democratic institutions when financial tools evolve faster than regulation? His answers don't offer easy fixes, but they call for thoughtful adaptation, inclusive policy, and above all, public awareness. This is more than just a book about economics, it's a guide for navigating a world where the rules of money are being rewritten. If you care about financial freedom, equity, and the future of how we live, Money in the 21st Century offers essential insight. If this resonated with you, please like, share, and subscribe to help spread awareness and spark meaningful conversations. And if no one told you lately, remember this: you are loved, you are worthy, and you are spectacularly capable of extraordinary things.